Good evening, everyone, and thank you so much for coming here today, listening to our story and our presentation. You might have seen our announcement 3 weeks ago about our H1 results of the 2023. We had a fantastic first 6 months. We have, just to summarize it, our H1 year-on-year increase on the turnover was 85% to 37 million pounds, and our H1 year-on-year EBITDA was 73% growth to 1.1 million pounds. So great 6 months to start with, and our aim is to carry that on to the full year. Today's presentation, we're going to talk about our last 6 months performance and our growth strategy as well. Just to give you a bit of a brief description about us, we are a technology-enabled labor supply company operating in the infrastructure sector. This slide is about our board. I am the CEO for Hercules. My name is Brusk Korkmaz. I'm a civil engineer, studied at University College London, and worked for companies such as MJ Gleeson, Hochtief UK, and Black & Veatch before starting Hercules in 2008. Today I'm joined by our CFO, Wheatcroft. As you can see from this slide, we've got a great team of non-exec and exec team with great blend of experience in infrastructure, financials, sales, governance, and even starting an AIM and running an AIM-listed company. We believe that we can take Hercules even further. This slide is about our business overview, how we go about our business and how we operate. You can see on the top of this slide some of our blue chip clients that we work for in the infrastructure sector. As you can see, the first pyramid is the biggest pyramid, labor supply division. So this is labor supply arm contributes 80% of our turnover, roughly, and we have got our construction services division where we carry out civil projects and we hire out our suction excavators for the infrastructure sector. At the bottom left corner, you can see that we have developed our 2 apps. They are the recruitment app and our One Team app. Recruitment app is called Hercules Construction Jobs, and it helps us to find local people for local projects. And our One Team app helps us to onboard them in a paperless process and efficiently. You can see at the bottom right, we've got a portal that we have developed under our digital arm called See Everything Portal, which is Skills, Education and Employment Portal. And we have licensed this product out to one of our clients on the Old Oak Common Station for HS2 called Balfour Beaty Vinci Sistra joint venture. As you can see from this, our digital arm it differentiates us from our competitors and underpins the whole business. Even though we are mainly a labor supply company, with all these services that we have got, one of our USPs is that we can cross-sell all of these services under the same umbrella, and our clients really like that. This is our strong growth history. I started Hercules in 2008 from a family spare bedroom, and we have been growing year by year since then. I'm just going to mention about some of the milestones that we have achieved. In 2021, we became one of the 6 labor suppliers on the framework to supply labor for Balfour Beaty Vinci joint venture for the HS2 Birmingham section. Even though we are 6 labor suppliers there, we supplied 25% of the whole workforce. Because of our apps, we can find local people for local projects and we can onboard them quickly. And none of our competitors have got this sort of capability, because IP rights of the apps, we have got them, and we developed this in-house. If I can move on to our 2022 IPO AIM listing, it is a major milestone for us, nearly 1.5 years in the AIM market. We are very excited about it. The reason that we came onto the AIM market to grow even further, and we are aware that the market conditions are not great, but we are there for the long term, and yeah, we are really excited about this opportunity. The next one is August 2022. We located a site in Nuneaton and to start our training academy there. And we believe that because there's a skill shortage in the UK, especially after the Brexit. sorry, I'm hungry thinking about food. Sorry. Because of there's a skill shortage. One of the reasons being Brexit. We believe that we should have a sustainable approach of finding local people for local projects and upskilling and cross-skilling them. And we believe that is so important. And we also want to monetize this opportunity as well by selling construction-related training to other companies or colleges. And we believe that this is going to play an important role for us. And our plan is to open that up early 2024. Lastly, we started our two new divisions, Hercules White Collar Recruitment and our Hercules Site Security divisions. And they started in November 2022, just a few months ago. And they already started bringing some income, which is very, very exciting for us. And we believe that these two divisions are going to grow even further within the next few years. The next slide is about our achievements for this year. So, as I mentioned, our H1 year-on-year increased by 85%, and we are trading in line with market expectations. As you might remember, in 2021, our end-of-year accounts and 2022 were around 50% growth. And this year, we are targeting, forecasting around the same as well. And so our forecast is £74 million, and our target EBITDA is £3.5 million. And yeah, we are going to achieve that, hopefully. That's our plan. And strong growth across all divisions. Labor supply, under the labor supply arm, we've got two new divisions, as I mentioned, with our white collar and our site security divisions. And we have got our suction excavator fleet increased from 16 suction excavators to 30. So up to January, just a few months ago, we had only 16. Working really well, by the way. These suction excavators, really good gross margin, 50 to 60% gross margins. And since January until March, we had another 10 came in. So we got one of the biggest fleet in the UK now. And our aim is to, so you are going to see some more a turnover for the second half of the year, as well as EBITDA contribution as well. So yeah, we are in a good place with the suction excavators, and which we will talk about a bit more, by the way. They are so exciting. I mean, it might take a couple of hours for me to sort of explain to you, because I get excited about it, but I'm sure I can maybe do it within 5 minutes for this. We have been paying dividends since we got IPO'd, and our aim is to pay more dividend. Carry on paying dividend to our shareholders. And I mentioned about our training academy. We believe that this is so important for not only for Hercules, but also for the UK's next generation workforce. There are hundreds of billions of pounds to be invested in the UK infrastructure sector, and we need people not only just giving people a qualification and just and leaving them there, because these qualifications all have to be renewed every so often, but that person to have more qualifications. So they have to have a multi-skilled in order to qualifications in order to close that shortage. As the last bullet point about infrastructure and construction sectors are experiencing continued buoyancy, providing a supportive backdrop for our growth. I think this is clear from the government spending on the investments committed to the construction sector.
Thank you, Brusk. I'm a CFO who is here tonight to explain his results and take any questions. This is our statement. It shows the 2.5 years in comparison. So, as Bruce said, gone up from 19.9 to 37. That's a 85% increase. EBITDA increased 73%, 0.6 to 1.1. So we're on course after 6 months into the year to achieve our market expectations. And we're very proud of that, because, you know, we're a business that's been growing every year since 2008. Slight dip in COVID, like a lot of our colleagues here tonight saw as well. But despite that, we're growing, and we're going to grow further. In fact, that's our plan. We really only went to aim to grow. Yeah, we'll speak a bit more about that later. In fact, pre-COVID, we knew as a business that this growth was going to come. We knew the government had put all this money into infrastructure, and we knew we were a relatively small, lean, privately owned business, and we wanted to get a good share of that, and we knew we could do well in that in this enhanced environment, but we weren't really set up to do so. We had to grow. We had to grow the business, we had to grow management structures, we had to grow processes, procedures, systems. We had to get the right team, we had to think about what corporate level people we would have to do the IPO. So bit by bit, we started to build those overheads. And you can see here how the overheads continued growing year on year. And then, of course, suction excavators came along, and the IPO came along. IPO added another level of cost to us, as it always does. But the suction excavators have been coming along since August 2020. We got 2 in August 2020, and a bit more to 16. We got to 16 by January, and as Brusk said, we got another 14. The last 10 came just before the end of March, just before the expiry of the government's super deduction, which I think a number of you will be probably aware of, and that was very important to us because it takes a year from when you order these machines for them to come. We'll talk a bit more about suction excavators later, but the important thing here to mention really is that's part of the growth in the overheads. It also is the growth in depreciation and the finance costs because they're all purchased by a conventional asset finance. We finished the IPO in 2022, so there's no impact of the IPO costs in 2023. This is about the labour supply business, which is the biggest part of our business, about 75–80%, and it always will be the biggest part of our business. This is where we intend to focus all our growth efforts on in the future. Fantastic year, 110% in revenue growth. A lot of that is the northern section of HS2, but there's lots of other projects going on as well where there's a serious amount of growth. And there's lots more to come. Brusk will talk a bit about in the future, later on about other projects that's coming along. Good operating profit change. And where has this come from? Well, there's no acquisitions been made up to now. This is just organic growth, steady organic growth, strong project pipeline, and we're just working through it, gaining all the time. What are we gaining? Well, we're gaining new clients. There are 3 clients that came along in the first 6 months of the year. Galliford Try we've worked with a lot over the years, but we've never got onto the framework for highways. We now are. This point is one Brusk mentioned earlier on. I'm really proud of this. We're a new kid on the block, really, aren't we, in terms of labour suppliers in the UK. All our competitors have been around a lot of years, and we got onto the HS2 labour desk, 1 of 6, and we're always first or second every week almost in terms of the best achiever there, and hence we're doing 25%. We're shooting well and truly above our weight there. How are we doing that? Well, the apps is one of our big USP. We're able to get these people to sign up. I think we've surpassed this now. I think we're nearly 10,000 now. People who've registered on the app, so we can tell them when jobs come along that match their skills and their geographical location. We can notify them, they tell us, and we then, if we want them, we use the One Team app to onboard them, and we're digitally onboarding about 80–85% of the people we take on now, which is fabulous. And that, we want to be an efficient, paperless business in this sector. We don't want to be an old-fashioned construction company like many of them are. As Brusk said, we're a tech-enabled labour supplier. Finally, this is really important. Labour supply only succeeds if we can keep retraining. Every 3–4 years, they all need retraining. It's not one training and then it's for life. It's retraining. And that costs money. But it's really important to do it. Our clients expect it. And it's a win-win for everybody. So the guys who get the training, we take the opportunity to upskill them or cross-skill them. And they can therefore earn more money. They're more available to do more roles. Our clients love it because they've got more people with multiple skills to do the roles they require. And of course, we like it because we can charge more money. And that's the game we're in. We're recharging the clients to make our margin. These are suction excavators. This is a picture of one of them. It's basically a great big Mercedes chassis. On the back, you've got depending on what generation you are, you might think of it as a Hoover or a Dyson on the back, but a very, very big one. And they can suck the soil out of the ground around services to avoid the sort of problems you can get. If you hit services, you can hurt people. People have died, and you can cause huge penalties on the jobs and delays. Nobody wants that. Legally in France, you have to use these around services. It's not law here yet, but all our major clients are actually moving in that direction anyway. So we're following them. That's where the demand for this is coming from. It's big demand. There's only 2 companies in the world really making this level of suction excavators, both in Germany, and they can't keep up with the demand. So we had a good year. We started the year with, I think it was 16, and we got to 30 by the end of the year. We found our sweet spot now. We don't want to go above 30. We think it's a bigger, you start to become more of a big plant type business if you go above that. That's not our game. We're selling a service. It's suction excavator services. We send these vehicles out with highly trained individuals to fulfill what our clients want to achieve. So our plan now really is to maximise the utilisation on these 30 vehicles, get it really profitable, really well utilised, and part of that will be getting new clients. Again, we need to gain new clients in all our business sectors, but hey, I'm pressing the wrong button here. Look at these. We've got all these in just in 6 months, all coming along to us because our reputation has grown on suction excavators. And this is a little boost, really. I think 2 of the 10 that we got at the end of March have something called a triple fan technology. Now, I'm not technical, but I understand it basically means they've got a hell of a lot more power to get down really, really deep and suck more out. Again, it's an increasing demand from our clients, and we've got 2 vehicles that can do it. So we're going to charge a premium for that, and that's going to help us in the years ahead. Those 10 that came in, we had no benefit from them at all in the first half year. So in the second half year, we know we're going to do well out of those. Civil projects, this is where we tender on a fixed price basis for civil projects, mainly in the water and sewerage industry, working under the AMP asset management program. AMP 7 is the current one. We had a very good year. We completed 20 projects, all sorts of different size projects these, 30% increase in revenue. And we're really quite proud of this, is that this was actually written, I think, about 5 or 6 weeks ago. And at that time, we had 10 million of contracts in the book for this year. We only achieved 12 last year. So we think we're well on the way to, if not just achieving the same, hopefully bypassing that and increasing on that this year as well. Again, some more new clients, Amy, SGN, really important, nice contribution to the business both now and in the future. And we've been doing this, I think, since 2015, if I remember right. So balance sheet. So really the fixed assets are, and you can see a significant increase there. That is the suction excavators. They're about $500,000 each. Quite expensive items. So big change there. The current assets are the debtor book and the work in progress on the civil projects. Again, with that huge increase in turnover, you'd expect to see that go up in that way. The liabilities, if I ignore the split between current and non-current, is really the debt on the suction excavators. So they're financed over 7 years, each one, fixed interest rates, and we put 10% down and have got 90% funded. So we're well into that. So at that point in time, at the end of March, I think the suction excavator element was about 11 odd million. The rest of those liabilities, about 6 million in long-term property leases, which is, anybody who's aware of, from an accounting point of view, under IFRS, you have to capitalise. Hence, it's in the assets and it's in the liabilities. And we also use an invoice discounting facility, which everybody in labour supply does, because you have to pay everybody weekly, and then you invoice your clients monthly, and they're typically on between 45 and 60-day terms. So you need quite a bit of cash. And of course, as you increase your the amount of people that you're employing, as we have been doing at 3 more years quite significantly, that requires more working capital. We're a working capital hungry business. In terms of cash, we ended the half of the year with 2.6 million. We ended the same period last year at 1.6. We did a fundraise in January of this year, which raised 1.6 million. For working capital, for exactly that. And we wouldn't actually have achieved the growth that we have achieved if we hadn't had the availability of that working capital. It goes hand in hand with the growth that we can achieve. Of course, we've still been paying dividends. We're very clear on that. It's a contract we have with the shareholders. We plan to continue to pay those dividends, and where we can, increase them as the years go by. We have a progressive dividend policy. I'll keep quiet about numbers for a little bit now, and then I'll hand back to Brusk.
Thank you, Paul. As you might be aware, there's a huge investment being made in the infrastructure sector. So strategically, we are well placed to benefit from UK government's continued investment in the UK infrastructure sector. I'm just going to read these first 4 bullet points because they are the facts. So I just want to sort of make sure that I get I get it right. So in 2021, National Infrastructure and Construction Pipeline sets out nearly £650 billion of public and private investment over the next 10 years, of which 200 billion is to be invested by 2024-2025, supporting an average 425,000 jobs yearly. As estimated, 217,000 new skilled labour required in the UK construction industry by 2025. Huge investment in Hercules Korkmaz in the next 5 years, 22 billion for the HS2, 17.5 billion pounds for the renew and upgrade railway, 27 billion pounds in strategic roads, and 525 million pounds to bring forward developments in the nuclear power. And lastly, labour supply is high on the UK industry's agenda. Demand is close to 20 years high, compounded by demographic change and Britain's exit from European Union. So companies are expected to employ local workforce and evidence the expected improvements as part of delivery large construction projects. So as you can see, there's a huge investment being made in the UK infrastructure sector, and our clients require these people to build them. And also there is a skill shortage as well. So this is where Hercules comes into the equation, to find these local people for local projects by using our apps, and then put them to work. This is what we do, and we are good at it. And upskill and cross-skill them by using our training academy. And I think this is so important. We believe that the UK construction, we are going to be growing for the next 15 years. Not only this, but also there is extra work coming up as well within the renewable energy, as well as the nuclear reactors as well. There are tons of mini nuclear plants to be built in the UK, so we are self-sufficient with the energy in the country. And if you can move on to the next one, please, Paul. With regards to our growth strategy, we have got multiple growth opportunities. And the first one is the organic growth. As we have been explaining, we have been growing organically between all of our divisions. And we've got a strong pipeline of projects into H2 of financial year 23 and 24. With regards to our training and training academy, we would like to upskill and cross-skill workforce, but we also want to sell construction-related training to our competitors, our blue chip clients, as well as to the colleges and whoever really requires them. With regards to our white collar and site security divisions, we started these 2 divisions. They are bringing income, and we are going to grow these within the next few years. With regards to our digital arm, I think I mentioned it, C Portal. We have developed this product and started monetizing, and we want to push them to other blue chip clients as well as to other projects. Suction excavators, now we got 30 suction excavators, one of the biggest fleet. So we want to make sure that we are utilizing more, and we want to bring the utilizations up to 90%. At the moment, they are around 70-75%, and we can do that within the next, because there's a massive demand, and they will be really busy for the next few years. With regards to subsidiaries and partnership approach, we believe that this sort of approach will help us to accelerate our labor supply growth into new sectors and into new geographies. This subsidiaries approach, I don't know, you might have know a company called Mighty PLC. They have started this approach by partnering up with ambitious managers. So we believe that this is very suitable within our labor supply sector, and we started talking to certain individuals and to potentially start one or two this part of the year. And lastly, our M&A activity, we are talking to targeted acquisition targets within the labor supply industry only. Obviously, we can't tell you very much about this, but we are talking to companies with synergies of increasing our EBITDA and our turnover. And this is our last slide coming up, investment case. There are over 1,000 companies in the AIM market. Why invest in Hercules? We believe that we've got a really good investment case and a fantastic story. So we have been growing every year since we started the business, 2008, and that's what we want to do: keep growing and make sure that it is also really profitable, and we are getting that. Positive performance across all divisions and strong momentum has continued into 2023. And as I mentioned, we've got a significant cross-selling capabilities between our divisions and huge market opportunity. I forgot as well, there is you might have heard lots of sewage going into the water, right, into the sea, into the rivers. There's £10 billion of investment being made in our core markets. We work for Thames Water, we work for Southern Water, we work for Anglian Water, we work for Severn Trent Water, and recently we have been bombarded by work, and this will carry on for the next AMP as well, including. So what they are going to do, because the AMP7 started a bit late because of the COVID, they are not going to go to tender. These private companies, utility companies, they are not going to go to tender. They are going to combine the AMP8 with AMP7 with the current major contractors, and we are strategic partners with all of them. Lastly, we have got a defined strategy with multiple growth opportunities. So sorry about that. Thank you so much if I spoke very, very fast. It's not because of I'm hungry. Thank you so much. Thank you.
Terrific. Okay, thank you very much for the presentation, gentlemen. Any questions for our presenters? Okay, question here, please, Chris.
Two questions. The first one is, it seems you're focusing more on big infrastructure projects. Are you also looking at smaller scale projects? One idea that came to my mind was, for instance, home insulation, which is a big issue in the UK. There's a scarcity of labor and skill, and therefore it seems that you would have the skills for that. So that's my first question. The second one is, how much of, what share of your business do you envisage the training stream to represent in the next few years?
Great questions, thank you. So mainly, as you said, there are other opportunities in the home insulation or other areas as well within the housing. But our main focus within the infrastructure sector, because they are a must to happen in order for us to have clean seas, or make sure that there are roads are running properly, or people have got waters in their houses. So that's our main. When we start maximizing that, and there's plenty of opportunities, by the way. When we start maximizing, maybe we might want to look into that, because you can only do so much, right? And you don't want to sort of spread thin and do half a job. So our aim is mainly in the infrastructure sector. We don't work in the housing sector at all. So
and that's because it's very housing goes up and down, and a lot of companies have caught a cold in that sector. So up to now, we've pretty much avoided it, and we've stuck to stuck to infrastructure.
But maybe there are opportunities in the future that we are looking into it. And with regards to the second question, what percentage that our training is going to be? I mean, we have done the business case on it. It looks good. So we believe that it will start. It will become really profitable within a couple of years. It is hard to say at the moment what percentage, because I don't know what. I mean, we are growing, as you see, 50%, 50%, 50%. So within 2 years, where we will be, and depending on the percentage of that, it's a bit difficult for
even
me.
even after a few years, it'll still be a relatively small percent of the overall business, because the rest of the business is going to continue growing. So, you know, that's all about which one grows quicker. So it won't be a large percentage. You know, it might get to 5%, something like that. But it all depends, because there's a lot of demand for it. So let's see how much we can drive that demand.
Thank you.
Thank you.
Next question here, please. Thank you. Wait a moment for the microphone, please. Thank you.
I was just going to ask you, you're very highly leveraged. Are you able to basically explain a little bit more basically about the excavators themselves? So your lender, does the lender actually have a charge basically over the excavators themselves, or is it a floating charge over the entire assets of the company? In addition to that, are you able to expand basically on your weighted average cost of funding, you know, basically over the next 7 years, and also what, if any, covenants, you know, basically are in place for the lending? I appreciate, you know, you have, you know, basically a lot of opportunities that are ahead of you, but the impression which I'm actually getting basically is that you're almost over trading and spreading yourself, you know, basically too thinly across the different opportunities that you have at the moment.
Okay, well, the suction excavators, we wouldn't have been able to bought them without that funding. We're not a business that has that sort of cash lying around, but we could see the opportunity. They're not with one funder. In fact, there were multiple funders. There are many, many asset funders out there. I could have financed these 10 times each every time, because everybody wants these. Everybody wants to fund these things because they're solid. They're absolutely solid. There's items out there that are still operating after 18 years. So these are very in-demand assets. So yes, it is debt, you're quite right, but it's heavily asset-backed debt. Nonetheless, when you look at the balance sheet, you see the debt there, and we're fully aware of that. And you know, that's over 7 years, that will come down. So that's coming down. It's reached its peak now. It's not going to get any more, because we're not really an asset-heavy business, apart from the suction excavators. And that's the only part of the business that we have ever intended to make that sort of investment in plant, because it was a profitable thing, and we could see the cross-selling opportunities we could achieve with the other two parts of the business. We are, in that sense, heavily leveraged. I get it, but that is going to come down over the next few years, because we won't be adding to that debt. It'll just be reducing, and the turnover and the profits will be increasing.
And our aim is not to buy any more either. And also, as Paul mentioned, with regards to our suction excavators that arrived recently, probably, as I said, 14 of them, right, Paul?
Yeah.
Because of the super deduction tax relief, 1 out of 3 becomes free over the years. So it was time to buy, because there's a demand, and we are good at it. We are utilizing. It was 80% up to January. Now it dropped down to 70 because we got 14 more, but we are bringing them up. So it is the right time, we believe, that we invested. And also, most of the suction excavators, well, all of the suction excavator businesses in the UK are quite new, and they are run by the founders and owners. And now we started, even though, you know, PE companies started a project. Do you want to sell this? Do you want to? They're like, no, we want to, you know, let us maximize it. But let's see what happens in the future, right? There are massive opportunities within this. So, yeah, thank you.
Did that answer the question? Was there anything else in there that you didn't want?
It was just the weighted average cost of the funding as well. You know, because obviously with interest rates being very high, I don't know when the funding was negotiated.
Yeah, no, that's it. Sorry, I'll make that one clear. So the first ones we purchased were August 2020. We bought those. I think the interest rate was about 1.25%. So as the extra purchases have been done from then, all the way up to the ones that we got in March, the interest rates have obviously increased. The highest interest rate we paid was on the last 10, and I think that was 7.8%, if I remember right. They're all fixed interest rates, nothing's floating. So it's well covered, yeah, we did what we had to do to get them. But if interest rates had been a lot higher than that, I suspect we might have thought again. Problem was, when we placed the order, it's a year from when you place the order, interest rates were a lot lower.
it will have the taxes as well. Corporate goods.
Yeah, because I mean, the way that you get the benefit that Brusk was talking about is that you basically don't pay corporation tax for a good period of time. I think because of the ones we bought, I think we've got something like 4 or 5 million accumulated corporation tax losses that's going to run out over the next few years, which puts our CT paying off accordingly. So yeah, it was worthwhile doing to get that benefit.
And we are over time, but the gentleman over here has been waiting for one final question, please.
Could you explain the drop in the share price from 70 to 40 pence in February?
Yes.
Great question.
Sort of explained it as much as you can ever explain the stock market. So we went to the market in January, and at the time the share price was about 55 pence. And we took advice from our brokers, who took advice from the various funders. And it was clear that if we were going to raise any money at all, we had to give a 20% discount. We wouldn't have got a penny if we hadn't have done that. That was the way the market was. Coming back before then, we went to IPO in February 2022, which, as it turned out, was a very, very tough period for us. I think we got one of 11 or 12 IPOs in 2022. I think if we'd been a month later, we might not have got it across the line. And we not only, was it tough to get it over the line, we didn't raise the money that we wanted to. It just wasn't there. Everybody wanted to sit on their hands. So if we had, we wouldn't have come back to the market in January of this year. But that's the reason we did, to obtain more working capital, to keep this phenomenal growth going. Now, what happened after we made the decision with the broker's advice to give a 20% discount? We offered it at 45 pence to the funders. They all agreed to do it. And at that point, the share price went up to 72 pence, which is nothing to do with us. It just did. And obviously, as soon as the funding was completed, that brought the whole share price down to 45 pence. Again, that's just a factor of the way the market works. We take the view I think some of our colleagues tonight have said the same things. We can't control the share price. What we can control is what the business delivers. We're firmly of the view that over the next few years, our results will come through, and that share price will eventually sort itself out. But we can't pull a lever and make it happen overnight. We haven't got that power.
I think just to add to Paul, I think because we were announcing our end of year results as well in January, and I think it just brought a momentum. Again, we delivered another 51% sort of increase, and we want to keep doing it. But we had to do what is best for the business in order to grow another 50%. We had to do this, especially 14 more suction excavators coming this year. But now we are well funded to deliver this year's growth, and we want to crack on for the delivering end of this year's results. Thank you.
Lovely. Brusk, thank you very much indeed. I was right about the time.